Google Finance, you can see the sectors over here on the right. And we basically just pick a sector and we go through the companies and they have a list at the bottom.
That's right, technology.
Technology. And here's a list of companies at the bottom that tells you the quote, what their change, their market cap, and their PE ratios. We try to find stocks that we can afford, decently priced, mid-cap, small-cap stocks with good PEs, nice annual revenue, and nice net income. After you pick a company, we generally go to Market Watch and try to check out their financials.
A little bit slow. All right, here we go.
Okay. Okay, you can see the financials in there. Under financials, you have 3 different things to look at. It's divided up into income statements, balance sheets, and cash flow statements. And you can look at the quarterly or the annuals. Right now, we're looking at the annuals. As you can see for Nokia, the revenue's increasing, the gross profit's increasing, and the income's increasing. All of this while they still are buying back shares and have a steady dividend. That's a good sign of a good company, After this, we usually go to the balance sheet and we check out the equity versus the liabilities on here, And as you can see, their total assets is about 30,000 and increasing, well, decreasing now, but increasing. Their liabilities are increasing, but if you look at their liabilities compared to their equity, you can see that it's just a small portion.
And also this long-term debt, right?
Yeah, and their long-term debt is very low. It's minimal. But if you go to ShareBuilder, you can confirm this because they give you all these ratios, like how much long-term debt to equity and all that stuff. They give you the percentages. And you don't have to have a ShareBuilder account to actually check this out. You can just type in the symbol.
Healthcare and unqualified.
Okay, this is a basic business summary of Nokia. It gives you their business plan, what they do, how many customers they have, and all that. But when you go down, here's the ratios. Here's their long-term debt at the bottom left, at debt to equity ratio of 0.01. That's good. And they also have a profit margin of 10.2. You can see that their return on equity, investments, and assets is all really good. And they also have a P ratio of only 18.10. That's great. After we look here, we usually try to see what stock charts are doing, where this stock is going right now in the market, Under stock charts, you can type in the symbol, and they have several different views, sharp charts, gallery views, but you can get a host of charts from here. Okay, this is the gallery view. As you can see, there's a daily view, a weekly view, and a point figure chart. The thing is, as you can see now, Nokia's value is currently above their market average, or their moving average, And when you look at these, you want to try to see if it's turning back. As you can see, there's this little dip there, but you don't want to buy when a company's overvalued. Usually, when a company's over its moving averages, you're looking at returns that are generally less than what you were going to get if they were under their moving averages and moving up. So you can see that Nokia's moving average is for 50-day 2310, and its current price is 25 something. So since it's over its 200-day average, you don't know how much profit you stand to make. But if you go down here, this is the cash flow. The weekly says that they're looking pretty good. But to really analyze this, you have to get into the figures, the candlesticks. And there's not really time for me to cover that, but Stock Charts has a chart school, which has all the information you can learn about, all the information you'll need. But it's there. And that's basically it. After we see which way the stock's going, if it's going good, we want to compare, we usually go to MSN Money. Here, this will give you basically what the analysts think, what the fund managers think it's going to do. And you type in the symbol. And you come out with a stock rating of 8. And if you look at the stock rating, it gives you their opinions on why you think. And you can compare what they think to what you think, Because right now, Nokia almost looks like it's still going strong up, And they say, it's good, it's pro, But that's what it is. And if to confirm this, even if Nokia didn't match up with what the analyst said, and we still wanted to buy it, you can go to their website and check it out. I mean, they always have shareholder relations and stuff like that, you know, and if they maintain a good website, that means they want their shareholders to come visit and actually check it out. This is Nokia's website. It's nice, you know, it's clean. You can tell that it's been updated recently. It has 2007 copyright date. A lot of stocks that we check out, actually, their websites are really, really old. You can tell that they don't maintain them, you know, so they don't have any current investor relation, current projects, anything like that. But Nokia maintains a good website, and that's the key. You know, that tells you that they want their shareholders to visit. They keep all their information up to date.
So we have just told you briefly how we approach when we pick a stock. So now let me tell you a little bit about financial statements, the difference between the rich and the poor. Okay, here on this slide, you guys can see the financial statement of most of the employees. You can see that they have only one source of income to cover all the expenses such as tax, mortgage, clothing, fund, and everything. So, you know, they have to wake up every morning with the fear of getting fired because paycheck is only income that they have to cover all the expenses. But the difference between the rich and the poor is, here you can see the financial statement of the rich. You can see that they have more than one source of income. They have interest rate, dividends, and so on and so forth. And at the point when their assets such as stocks, bonds, notes generate enough income for them to remain their standard of living, they actually achieve their financial freedom. And you know what is the difference between the rich and the poor? Only one thing, that the rich know how money works. They acquire their financial education as soon as possible so that the numbers are meaningful to them, so that numbers tell a story. Now, that's like you read like a story. So, you know, but the most important thing for us now is we are having fun. You know, the fun looking at different companies, the fun analyzing different financial statements, the fun looking at the price going up and down, the enjoyment. And, you know, also the desire, talking about a stock. You know, it's cool because you talk about stuff that people don't know. So you can show off a little bit as well, you know. And the important thing is you can always tell them, this is important. You should do it. You know, if you have questions, talk to us. Join the club.
Another important thing is to learn to appreciate money. There's a saying around election time, every vote counts. Well, there's an equally important saying in the stock market, every cent counts. Basically what this means is you have to achieve financial freedom, you have to make your money work for you. Without that, you'll never, you know, have security in the future. You'll always be working a job, always be scared that you're going to get fired. And you know, the main thing is, if when you invest, you have to spend less time at work, which means you can spend more time with the people you love.
And you know, this is, for example, my parents. I think they are quite successful in the business, but the thing is, they never had time for me. We never went to a trip together as a family. So I think at some point when you have your asset generate enough income for you, you don't have to go to work, which means when you have your kids, you can spend your time with the people you care about, with your friends, everything. And investment will enable you to do that, to make that happen. And now we want to give you some recommendation on how to get started, how to start investing. The first thing we think the best way is to join our investment club. Why? Because then you have constant interaction with me, Ben, Eric, Travis, and all other members from the club. And also, we would recommend to start with an account such as Shell Builder. You know, just put $50 in there, and you see how much you can learn from it. You read the news, keep in touch with the companies, look at the website, and so on.
Another, you know, recommendation we have is, you know, you can't read too much. And the thing is, we learned a lot from these books. If you want to get a basic idea of, you know, what a financial statement looks like, you know, what to look for in a good stock, what to invest in, any ideas on how to pick a stock. You know, for instance, stock investing for dummies, that's a good way to get involved. You know, it's the first step. You know, Rich Dad, Poor Dad, it gives you the philosophy on how to be rich, you know, like why you should be rich, how to do that. Beating the Streets by Peter Lynch. He has a lot of ideas on stock picking, he tells you a lot of good stuff. And the Motley Fool and other investing guides, they just basically give you the idea that here's how you pick a stock, this is what they do, and they give you like a little idea of this is how they became successful. And you know, basically you want to improve on that and beat them. These are the professionals.